Matt, hi, morning. Great to have you on the show as always. Matt, let's try and understand what the global market construct is looking like to you and where do you think US equity markets are headed next? Because off late, they've been a little bit in a quiet zone and you're not seeing much of a correction in the MAG-7 as well play out.
Hey, good morning, Aisha. It's always great to join. And I'm still optimistic and constructive on where U.S. equities can go over the medium to long term. But one of the challenges that we're seeing in U.S. equity markets through all of the sideways movement that we've had has been a little bit of weakness at the top. The Magnificent Seven, a lot of the prior leadership that we've had for the past few years just hasn't been working that well. And you've seen a lot of rotation beneath the surface. And when I talk to clients, a message I've been giving for a while has been, we need to see rotation to have a sustainable bull market over the longer term. So it's healthy that we're starting to see the broader market, especially cyclicals, work because the economy itself remains in a really, really good place. But prior leadership also has to continue working at least a little bit in order to get the market to push to new all-time highs. So I'm a little bit more concerned in the short term that there is the potential for a pullback, simply because when this rotation trade, stalls a little bit, unless the top of the market starts to catch up, you might have a challenge and a little bit of air pockets as some of the more systematic traders in the markets start to sell. But the main takeaway is that any downside that we see, I think, is a very good buying opportunity for clients because the fundamentals of this market remain strong. Earnings growth has been very, very good, well above expectations. Margins are at or near all-time highs on the S&P 500. All parts of the economy are working, and the global economy is also doing well. So if you do see a pullback, I would use that as your opportunity to get in if you as an investor might be underweight or don't have a lot of exposure to U.S. equities.
Matt, I wonder, hi, very good morning. I wonder if you have a view with regard to how crude is moving. There is a view which somewhere says that there's a lot of crude which is currently at sea, and once that crude gets freed up in terms of logistics, you could see crude prices soften. But for the moment, it's not looking like it. I know some of the moves are related to US and Iran. But what do you make of the overall structure and construct of crude? Do you believe that $70 on the barrel is sustainable? Do we see a bit of a cool off? Can it harden further? I'm trying to get a sense.
Yeah, it's a good question, and one a lot of clients have been asking, especially given how strong energy stocks globally have been to start the year. I do think if there is a positive deal reached between the U.S. and Iran, there's certainly scope to see some of the gains that we've had this year unwind, because at the end of the day, as the world pushes towards electrification, there's just a structural supply-demand imbalance with respect to where oil markets are. And somewhere probably in the mid-60s is maybe a better place where the price reflects that sort of balance. So you could definitely see some of those gains year to date unwind and some weakness in energy. But overall, prices are still relatively low. So I think it's largely unwinding the positive gains you've had as a result of US-Iran tensions. If there are tensions that escalate, there is scope for oil prices to move materially higher, because then you're talking about the situation like we had last year, where the Strait of Hormuz could potentially be closed, where a significant amount of oil output is actually moving. So at least right now, until we have resolution, I think the risks are still skewed more towards the upside. But I wouldn't be surprised if over the medium term, when we have resolution, that you see a little bit of softness, but I don't think it's going to be extreme.
Matt, how do you look at the Fed minutes? Though it seems to be a little bit on a hawkish side, with many of the participants, talking about a possible rate hike if inflation continues to be high. But it seems the market is discounting that entire minutes for now.
Yeah, Sujit, it's interesting because I do think that the minutes came in more hawkish than some of us were anticipating. But at the end of the day, I think we can take solace in the fact that you still have two Fed voting members who were willing to dissent and move towards rate cuts. I think on balance, the main message isn't so much that rate hikes are in the imminent future. It's more that they just wanted to see the statement evolve to reflect more two sides of balance, that if inflation persists above trend for a long period of time, that there is the potential that rates could be hiked, and at the same time, rates could come down if we see softness or employment concerns. So it's still net hawkish. I would have expected to see a little bit more of a move at the front end of the curve, especially that is reflective of what the Fed's going to do. I actually believe that we're probably only going to see one, possibly two rate cuts this year. So the market is still ahead of itself, and I'm surprised that the minutes didn't kind of rein that in a little bit as well. So it'll be interesting to see once we get to March and we get PCE, we get another inflation print, whether or not you start to see a little bit more of a shift with respect to interest rate pricing. But I do think the bias, at least for U.S. rates, is higher in the short term.
Okay.